Welcome back, you legends. I'm Dr. Cal. Let's get right into today's video. We have red all over the place today. All the indices are down, led by technology and the NASDAQ, followed by the S&P, the Russell, and finally the Dow Jones holding up the best. Again, just like yesterday, despite yesterday being a green day, we talked about the sector rotation and we had energy, utilities, basic materials, and real estate. These four inflationary sectors led the market yesterday off the heels of a hotter than expected PPI. So what led the sell-off today? Well, we had consumer sentiment came in below expectations, 67.7, still above 50 legends. Whenever consumer sentiment is above 50, it is considered expansionary, meaning we're not at recession yet. But this is not really the reason behind the sell-off today. If I pull up the VIX, you will notice that the VIX actually began rallying well before the market opened, well before the 10 a.m. consumer sentiment report. It began rallying well ahead of all of that. Let me add the S&P so you guys can see what I'm talking about. Look at this. The VIX was rallying 2 hours before the market opened. And if you remember, legends, yesterday I mentioned the VIX. I said, watch the VIX. If it gaps down and then recovers, it's going to be an indicator that the market will sell off. If the VIX gaps up, it will be an indicator that the market will rally. I love using the VIX before the market opened because it tends to give us a hint about how the day is going to go. And to start the day, the VIX was already up, producing a bullish piercing candle. Now at the close, it is a bullish engulfing candle, just like this one that marked the stock market top on July the 27th. So we gapped down, rallied. That was the first warning sign. And then the selling continued after the report. So we had a trend day today, declining throughout the day with some attempted recoveries, but they all failed. Leading the declines today was Microsoft, Nvidia, Meta, Amazon, Home Depot, and Lowe's. So we have technology-focused semiconductors, chip makers, and we have consumer discretionaries all declining. All of these risk-on optimism sectors are down, and all of the pessimism sectors are up. Look at this: utilities, materials, real estate, consumer defensive, healthcare. Defensive sectors, again, we're seeing hedging against inflation and defensive rotation in September. So let's get right into the daily chart for the S&P 500. We continue to coil within this pennant, this triangle. Today, we took out this prior low on a closing basis. Remember, on a closing basis, the low was 444. Today, we closed at 443.37. So we took out this low on a closing basis. We have developed what is very clearly now a bearish, a tombstone candlestick structure. Can refer to one of two things: either one, a gravestone doji candle, a single candle that looks like this, kind of like these candles. A tombstone candlestick structure is made of more than one candle, and again, it looks like this. You get one candle to the upside, one candle to the top, and one complete reversal candle that closes below the low of the first candle. We got that. We closed below the first candle. This is now extremely bearish tombstone candlestick structure. And look at the volume. Massive volume today, eclipsing anything going back all the way to June the 16th. So you'd have to go back 3 months to see any volume like this. So why exactly did the market crash today? You'll hear a lot of reasons floating all over the place. It's fairly simple. It's a combination of two things. One, higher than expected CPI and PPI, and two, bearish seasonality. We'll hear a lot of people try and explain this away. Oh, it's some news event, something happened, blah, blah, blah. It's very simple. It's higher than expected CPI and PPI, and it's bearish seasonality. Let's take a look at the hourly chart to get a more granular look at what happened today. So yesterday we had this gap up and rally. I discussed this double bottom in the prior day on Thursday. On Wednesday, the full measured move for that double bottom was 449. So we got there at the open, and we also had this flag As soon as it broke, it also generated another target, and we met that target the same day. Look at this, it generated a target of 451.2 roughly. This major resistance line, we did not tag it today. We came very close to tagging this major resistance line that stopped the prior rallies at the 52-week high this year and the prior high in late August. We got a huge dump today. Look at this. Massive gap. Measure from the close of yesterday to the open of today. That's $3. Then continued selling. Then a flag to end the day. This now looks like a very clear bear flag. We can generate a target based on this bear flag. And it actually takes us below 440 to 439.4. And what's at 449.4? And what's at 439.4? Let's see if there's anything there. Well, there's a gap. Okay, so that's kind of funny how it plays out, legends. I'm just measuring this with you right now in real time. There is a gap at 439.4. So this full measured move actually makes sense. Now, very interesting, if we take out this support line, it's this support line on the daily chart, we will almost certainly take out this prior low and fill the gap of 431. How likely or unlikely is that? Based on market seasonality, we should actually undercut this August low in September and then do it again in October. Here's what seasonality looks like. At the end of September, we often form a new low, taking out all the prior lows in September. And if I take a look at October, we also take out all the prior lows going back to August. On the daily chart, we also have another bearish development. It's the close below the 20-day moving average. Remember, this pullback held above the 20-day. So this is the first break of the 20-day since this big correction in late July, early August. And legends, when we break below the 20-day, we nearly always get more and more weakness. Even when the market is consolidating, when you break the 20, you get more weakness. When the market is uptrending, often when you break the 20, you get more selling. When the market is trending down, you get crashes, basically crashes. Now, the trend is weakening significantly, and I'd say it's losing direction. That's very common in August, September, and October. You get a lot of choppy trading until the end of October, and it's evident by the 50-day moving average, this green moving average beginning to flatten. We continue to trade within the confines of this pennant. We haven't broken it yet. We haven't broken to the upside or the downside yet. If we break to the upside, again, 456 gap fill. If we break to the downside, we go back to fill the gap at 431, this gap that we haven't yet filled. Even when we broke all the way down to 433, we came very close to filling the gap, but that's still unfinished business downstairs. Now, there's absolutely nothing that says that the market has to break to the downside or the upside. Nothing really. The market could just continue to chop all the way into September 20th. What's happening September 20th? Well, we have the Fed meeting and the Fed interest rate decision. That's September 20th. The market is pricing in a 3% chance of a rate hike. So the market is completely discounting a rate hike in September. The market has also began discounting a rate hike in November. The odds of a rate hike were at 40% to start the week. They declined to 35% after the CPI and PPI. Inexplicably, honestly, because both CPI and PPI were much hotter than expected. Today, those odds declined again to 30%, but the December odds are now up. The December odds are now 35% for a 25 basis point hike, and now we have new odds, 4% for a double hike. So the market is being really dumb here. The market is pricing in one hike in November and potentially another one in December, but it's reducing the odds of a rate hike in November, which makes completely no sense. If you want to price in two hikes, you might as well price in one hike in November and one hike in December. Now, this goes against the official stance of the Fed. The Fed is expecting to raise rates one more time this year to end the year at 5.75%. So the market continues to fight the Fed, and you don't really want to fight the Fed. Now, 443 is actually an important level of support because the market held at this level previously. We also had breakouts at this level. So it is an important pivot zone, 443. We also have this support line below at 440. So I do expect buyers to step in here. However, keep in mind that even if the market holds at this critical support level, if it does not produce a quick recovery, it will form a bear flag, a very large one at that. So all eyes now are on the Fed. We only have 2 additional trading sessions until the Fed interest rate decision, Monday, Tuesday, and then the Fed will announce a decision Wednesday. And the press conference is going to be extremely important because the Fed will hint at additional rate hikes or a pause. As of right now, in my opinion, I think the Fed will stick to an additional rate hike based on how hot the PPI and CPI were this week. Let's take a look at the weekly chart for the SPX, the S&P 500. We continue to form this reversal pattern. We had a rally 2 weeks ago. Last week, we had a reversal of that rally. We had an attempted rally this week, but we did not manage to break the prior highs. This now looks like a rollover formation, and it came in at a very, very strong volume. This now is a tombstone candle after another negative week. And we're entering one of the most bearish times of the year. That's the second half of September. It tends to be very, very bloody. We tend to get very quick sell-offs, erasing all of the upside made in the first half of the month. In fact, if I take a look at the monthly chart, look at this. We've already erased all of the gains of September. Now let's take a look at the high-low index and the Fed liquidity indicator. Below is Fed liquidity. In the middle is the high-low index. This is a very vulnerable look. Same vulnerable look on the PPO. Fed liquidity is declining as well. So we've recently had this very weak attempted rally, and we're in an extremely vulnerable time of the year, and Fed liquidity continues to decline, and the market is discounting a rate hike. So a lot of things to go wrong between now and October, and there's still no end in sight for this chop. Let's look at the NASDAQ. The NASDAQ is again very close to tagging this support line. This is an important support line. If we break this support line on the NASDAQ, very likely we move all the way down to 332. That's a big move. That's a huge decline for the NASDAQ, 10%. How likely is that? Well, based on the fact that we're so far away from the 200-day moving average, and it's a seasonally bad time, and inflation is resurging, I think tech will continue to suffer. The big rallies will happen in defensive sectors. Staples, utilities, big money will continue to buy those sectors in favor of tech. Tech still has a lot of downside left to go. What about the Dow Jones? Let's take a look at the Dow Jones. Doing better than the NASDAQ, doing better than the S&P 500. Still hugging this support line. I don't like it when price hugs a support line for a long time. The more times we tag a support line, the more likely it breaks. It's like taking an axe and hacking away at a tree. At one point, this tree will fall over. The Dow continues to do that, even though it's outperforming the rest of the market, both S&P and the NASDAQ, but it still looks vulnerable. Now, the Russell is the best looking out of all of these, even though it is forming what looks like a head and shoulders top. The neckline for this head and shoulders is at 180, so the Russell needs to break 180 to get the full measured move down all the way to these prior lows. Otherwise, if it holds at 180, it will actually form a double bottom with a positive divergence and rally. So it's a very complex structure forming on the Russell 2000. It continues to hold the 200-day moving average, but it's also forming this nasty head and shoulders topping formation. I really would like to see this head and shoulders top invalidated. The only way to invalidate that top is to hold at the 180 level, then take out this prior high. And the only way to validate the head and shoulders top is to get a break below 180. That's all it's going to take. Just a break below 180, and we get a full measured move that's actually very sizable. Let's measure it together. Here it is from the top to the neckline. Let's measure that distance again. Look at this. Goes back all the way to 160. The 2022 bear market lows. And that's why I really don't want to see the Russell break 180. What about the Dow Jones transports and the industrials? Surprise. The transports are now forming another divergence. Bearish. We have this bearish piercing candle on the industrials. The transports, on the other hand, are actually flagging and forming a bull flag. I'm also seeing a bullish divergence on the smart money. This is the smart money made a higher low versus these prior lows. S&P 500 made a lower low. So if the smart money continues to decline, we could still form another bullish divergence as the S&P takes out this prior low. I think that's actually likely now. Seeing how nasty the market move was today, I think that is likely. But expect bounces in the interim. Expect a lot of bounces in the interim. The high yield bonds and the smart money and the Dow Jones transports both hint at a possible counter trend move Monday or Tuesday, and it's the same thing with the VIX. Although personally, I would not trade that counter trend move. I would not risk it. I'd rather simply wait till the end of September, get all of this bearishness, this mixed bag priced out of the market, and trade the early October bounce. We usually get an early October bounce and a bottom to end September. Now I'm going to run through my risk appetite indicator. This is one of them. This is the risk appetite indicator in the bond market. I use it because it's a lot more accurate than risk appetite indicators in the stock market. What is risk appetite? Well, when there's a strong appetite for risk, you'll see market participants buying the market, specifically high risk assets like technology and high growth names. And when you see risk appetite decline, you will see rotation out of the stock market into defensive assets, things like gold, things like treasuries, things like the dollar, and things like defensive sectors within the market, like utilities. So, what does the bond market risk appetite look like? Well, it is still much, much better than the S&P 500. We have this huge divergence. As of right now, this divergence can be taken out Monday, especially if we get a gap down Monday and the VIX shoots up again. This divergence will be taken out. But as of right now, there is a bullish divergence where the risk appetite in the bond market is holding up much better than the stock market. So kind of the same bullish divergence that we're seeing on the high yield bonds. What about the risk appetite in the stock market? This is XLY divided by XLP, so consumer discretionary divided by consumer staples. Big decline today, but it held above the 10-day moving average. So we're getting mixed signals here. We're getting bullish divergences on the HYG, the bond market risk appetite indicator, and we're getting this ratio chart holding above the 10-day moving average. Often when we hold above the 10-day moving average, we continue higher. We've held so far. We will see if we get follow through to the downside on Monday or not. What about the NASDAQ relative to the S&P 500? I discussed this yesterday. This is a more clear-cut signal here. It is rolling over. The NASDAQ relative to the S&P 500 is very clearly continuing to weaken. What does that mean? Well, it basically means to stay out of tech unless you're accumulating for an investment position or something like that. But for a swing trade, market dynamics now are unfavorable to trading tech companies. This is VTV divided by VUG, so this is value, Vanguard value divided by Vanguard growth. We have another huge divergence here, legends. We had this prior divergence. It actually marked the top in the stock market. This is the stock market, the S&P down here, and it marked the top. We're now getting another very sizable divergence, and we're getting a breakout in value relative to growth. This is a defensive rotation. You don't see value outperforming growth unless the market is doing very, very badly and is bearish. And this is precisely why you're seeing the Dow Jones outperforming the NASDAQ. Let's take a look at the S&P 500 to gold ratio. I use this chart to identify the beginning of an uptrend. We lost a lot of ground today. We're pretty much 1 day away of invalidating this buy signal. If we do that, this will be a whipsaw signal. And these tend to come in periods of choppiness. Just like this buy signal was invalidated here, the market was actually moving sideways. Then we had the final dump and the bottom. Kind of the same look, right, legends? Slight rally, and then just chop sideways. And we're getting a whipsaw signal on the SPY to gold ratio. This goes in line with a lot of the trend indicators, like the summation index. Same exact look, legends. This is the NYSE summation index. Down here below that is the oscillator. Up top is the S&P 500. And yet again, we're getting a lot of whipsaws, cross up, cross down, cross up. These whipsaws tend to happen when the market is in a choppy period. Although good news is after the end of the chop, we tend to get a bottom. I expect that this choppy period will last for 6 additional weeks. I think it will end by the end of October. They have a lot of reasons to say that. I think the Fed rate hike will be priced in between now and October, so that bearishness will get priced out. Seasonality will also improve, and we'll get a lot of earnings reports in November and October. And if they're positive, that'll be another catalyst to the upside. Are there any divergences, anything to go by? Right now, no divergences so far, with the exception of this very minor divergence, lower low on a closing basis, even though the oscillator made a very slightly higher low. So we are getting divergences in the short term, high yield bonds showing a divergence, risk appetite indicators like the bond market risk appetite indicator is showing a divergence. XLY divided by XLP is holding at support, but it does look very bearish. Legends, still same look here. We have a rally, indecision, massive sell-off, tombstone candlestick structure. If it breaks the 10-day moving average, we will likely have completed a double top with a bearish divergence. And when that happens, we usually get a period of weakness both in tech and discretionaries. So things like Tesla and Amazon specifically tend to suffer really badly when this ratio chart is declining. Let's take a look at more risk appetite indicators. This is the CPC buy and sell signal. Hasn't updated yet. I'll update you again, Legends, with the weekend update video, and we'll cover this again. But yet again, so far, no buy signal on this chart. What about the PC put to call ratio? It is trying to roll over. It is rolling over, but it hasn't done so yet. Quite often, Legends, when this signal rolls over, we establish a sizable bottom. Very important bottom. Not there yet, but we're inching closer. What about breadth? This is the 50-day breadth. Hasn't updated yet, so let me skip it. 200-day breadth hasn't updated yet, so I'll have to skip it again. Very likely, we would have gotten a big reversal candle, but with a higher low, just like the Russell here. What about the different sectors? This is the month-to-day performance. Look at this, Legends. Energy was somewhere in the middle. It is now leading. Utilities was near the bottom. It is now leading. Gold is now beginning to lead. The NASDAQ was at the top. It is now declining. S&P, XLK, that is tech and communications. Things like Apple, Microsoft, and Google. Those were leading. They're now declining. This continues to look like a defensive rotation. So let's take a look at the different sectors, Legends. I'll cover all the sectors in this video relative to the S&P. This is the S&P 500 down below. We'll start with the XLK. This is XLK up above. This is the S&P 500. They're tracking fairly similarly, but notice this bearish divergence. XLK made a lower high as the S&P made a higher high. Very clear bearish divergence. So this is a sell for tech. Let's take a look at communication services. Communication services holding up better than tech, but they're forming this very clear, to my eyes at least, ascending wedge. These ascending wedge patterns always produce very huge sell-offs when they break. So just waiting for the break. When we get that break, that will be a sell signal for communication services. Now let's take a look at XLY, consumer discretionaries. So things like Tesla and Amazon are in this name. Still wedging, no break yet, so we could still see some additional rallies in Tesla and Amazon, but likely bottoming soon. In fact, let me pull up Amazon and Tesla. Let's just take a quick look at both of them. This is Amazon. Looks very bearish to my eyes now. This does look like a double top with a bearish divergence. It was looking very strong right up until today's break. Again, this was a wedge. This was the support line. It broke today. Very likely continued selling down to the 50-day. Let's look at Tesla. What does Tesla look like? Tesla still looks much stronger. Well, but it does have this nasty resistance line. Let me extend it. Very close to tagging it. It stopped all of these prior rallies. Let's try and refine this resistance line just a little bit more. There you go. This is a perfect tag, perfect tag, perfect tag, perfect tag. Okay. How far are we? Let's take a look. We're just 5% away, 15 bucks, 290. So a rejection at 290, that will likely be the top as well for Tesla. Now let's take a look at consumer staples. Consumer staples looking much stronger than the market. The market is making a new low today. while consumer staples is actually now forming an uptrend, this uptrending channel after forming a double bottom. So that's bad news for the market. When staples are outperforming the market, it usually means it's a very bad time to be along the market. Let's take a look at utilities. It actually formed this huge tombstone candle. Forget follow through to the downside on utilities. That will actually be bullish for the market, at least in the short term. Now, with that said, I'm not convinced that utilities are done rallying. Why? Well, because they closed above the 50-day yesterday and they closed above it again today. Even though there was this sell-off in utilities, we're still above the 50-day moving average. So even if we get a huge pullback, we still could see a lot more upside, especially as the PPO continues to move to the upside. What's the full measured move on this double bottom? Let's take a look. It's actually all the way up at 66.6. That means 2.5% more of upside on utilities. So utilities continues to be a buy. XLP, consumer staples, is a buy. Technology, definitely a sell. Communications, inching closer to a sell. Consumer discretionary, inching closer to a sell. What about energy? XLE. XLE is also forming this humongous bearish ascending wedge. That wedge almost broke today. If I actually connect the lows, it did not break yet, but it is very close to breaking. And if it does, that big rally in oil is likely to come to an end as well. Okay, what about the fear and greed index? The market is still trying to grind its way out of here. Has it done so yet? Stock price strength and breadth and the put to call ratio all showing fear. Again, legends, I'll update you on the put to call ratio soon. The VIX double bottom and broke out today, still below the 50-day moving average. If it crosses above the 50-day moving average, we'll get another at least 2 to 3 weeks of significant selling in the market. What about risk of recession? Well, let's see. This model looks at the yield curve inversion and correlates it with the probability of a recession. The probability is now very high. This is the highest risk rating that you could get out of this indicator. And if you take a look at the yield spread, every single time the yield curve got into this red territory, we always got a recession afterwards without exception. These recessions are highlighted in these darker gray areas. So going back all the way to the 70s, inversion, recession, inversion, recession, inversion, recession, double recession, again, 1990, inversion, recession, 2000, inversion, recession, 2008, inversion, recession, 2019, even before the pandemic, we got an inversion and a recession. Now we have the deepest inversion that we've seen since the 80s. And usually the depth of the inversion corresponds with how long and how deep a recession ends up being. And so this model is predicting a long-lasting, very deep recession that is likely to start next year. Why? Well, how do we time these? Well, basically, legends, after the inversion ends and the yield curve begins to steepen again, come back down, that's often when the recession actually begins. Notice, legends, the depths of the inversion came in February of 2007. The recession actually began at the end of that year, which was roughly 1 quarter after the yield curve uninverted and began to steepen. We're still quite a ways off from that steepening, which is why that 6 to 9 months timing is more likely than, let's say, in Q4 of this year. What about economic events coming up? Monday, not much going on. Tuesday, building permits, not really that big market moving event. The big news next week, no doubt, is the Fed meeting on September 20th. And after that, we'll get the PCE at the end of the month on Friday, September the 29th. That's likely when the market will actually form the bottom for September. And that, again, is based on seasonality. That's it for now, legends. I'll be back with another weekend update video to get into much nittier and grittier details into what we expect will happen next week and how to trade it. If you enjoyed this video, legends, slap that like button right in the face. That's one of the absolute best ways to help the channel. If you watched the video till the end and you did not enjoy it, I do thank you for your time and attention.
Oh, wow!